Hello and welcome to PRS. My name is Tshireletso and I'll be going through some of the problems that we encountered during our tech session. So I'm going to just clarify some of the issues we had and then do a bit of VET. So I'm not going to go really deep into VET, but I'm just going to give some guidance as to how to approach VET in a question. So yeah, I think we can start. Um, Before we start, I would like to, as usual, go through the MM approach, as it's very important to to use this approach, especially when reading scenarios, as using this approach will actually help you get a lot of information from the scenario. So like I said, the first thing when reading a scenario, even required, the first thing is perspective. So who are you? What person you are is very important. Are you a company? Are you an individual? Are you a trust? So it's very important to know who you are. And then the year of assessment that you are working with, right? So between what the year of assessment, so the date is very important. And then every date in that scenario reference it to the year, so to the current year of assessment that you are working with, as that will help you get more information from the scenario. But you'll see as we read the scenario or what I mean. And then after you have basically you know the person and you know the date, right? The third thing is to check what tax you are doing. So it's very important to know what tax you are doing. That's why I'm saying what legislation or standards are applicable. So what piece of legislation is applicable, right? Because different taxes have different so different pieces of legislations apply to different taxes. Different acts apply to different taxes. For instance, there's the Income Tax Act, there's a VAT Act, there's a Tax Administrative Act, there's a Estate Duty Act. You see, like all of those acts, they deal with specific taxes, right? So it's very important to know what tax you're dealing with before you start with answering the question, right? So don't make the mistake of calculating or doing um, like two taxes or using the rules in the act in the VAT Act and the Income Tax Act in one question. That won't help you. So the first thing is to determine what standard you're working with. So what act is applicable to that um specific question. Yeah. So however, it will be clear in the question. They'll tell you calculate the VAT or the income tax or the taxable income. So if they say taxable income, you know it's part of the Income Tax Act. So like I said, perspective, who are you, the year of assessment, and what standards or legislations are applicable, right? And then we move on. Now that you have that perspective, you know who you are in the year of assessment and the text you're working with. As you're reading through the scenario, you'll see triggers will appear. So what are these triggers? So the first thing is events. So what do I mean by events? So events are things that happen. It's either things that happened this year, right? So that's an event that occurred this year, and there are other events that occurred in other years of assessment. Like for instance, if we have prepaid expenses, that's an event, but it occurred in another year of assessment, you see. And then we also have things like events that occurred in previous years of assessment. So with those ones, in most cases, you are just gonna look at the requirement in the act and see how we should account for it subsequently. Yeah. However, for VAT purposes, you'll see in most cases the transaction, the end of the transaction will be in the year of assessment. Yeah, because you are using the accrual basis of accounting. Yeah. And for VAT, it's only taxed on supplies. So that's why it will be most probably during the day of assessment. Whereas like for income tax, it doesn't really matter for income tax. Yeah, for income tax, the reason is income tax, it also accounts for things like assets and yeah. And don't forget, income tax, it's looking at your income. So the profit that the business is getting, that's what the tax officials are taxing. So the profit that you're getting, as you can see, they allow you to include the income and most of the deductions, the trade deductions. So basically, the income tax is there to tax your profit, right? So the profit that you make, yeah. And then another trigger is like they tell you like that something like new information has popped up. So you'll see like when you're reading the question, the triggers, and I'll also like as I'm going through the scenario, show you like what I mean when I say the triggers, because what the trigger will do at all, like it will trigger it will trigger a section. So whether you should use this section or this thing is an inclusion or deduction, or for VAT purposes, what type of supply it is, it's very important to know what type of supply you're working with, whether it's a standard rate, exempt, or um, zero rated, and how to account for it. Yeah. And then after basically that it's a deduction, so what type of deduction or inclusion it is, so that's for income tax purposes. And then for VAT, what type of supply it is, right? You know the scope, basically, you know the section that applies to that specific supply or to that specific transaction, right? Yeah. So now basically you know the scope, this is the scope that this particular trigger, like, so that trigger will trigger basically certain sections that you have to use. And then as you read through the scenario, it'll give you more detail and confirm more like what is the scope. After you know the scope, all that's left is implication. And for implication purposes, it's always when. So when you should recognize that thing, that's very important. So time of supply, that's for VAT purposes, but also for income tax purposes, it's also very important to know when you actually account for something, right? Because it might meet the scope of a certain section. However, you might not be allowed to recognize that thing this year. Like for instance, some prepaid expenditure. You see that if like you pay an amount like during next year's year of assessment, that amount automatically is called prepaid expenditure, right? So section 23H applies to it. That's what I mean when I say that's the scope. That's section 23H now applies to it. Do you see? Then what is the implication? Implication is when you should recognize it. You remember for prepaid expenditure, right? There are some amounts like, so there are three rules, right there. There's that 6-month rule that the goods and services have to be supplied within 6 months. So if the goods and services are not applied with are not supplied within 6 months, you look at the second rule, which is the legislation rule, right? Whether those goods and services are according to legislation. If they're according to legislation, you're going to deduct them right in that year of assessment. And then what you're gonna do is, if it doesn't meet that rule, you're just gonna put it on the side, like I said, and then aggregate all of the prepaid expenditure that you put on the side. And let's say when you aggregate all of those prepaid expenditure, you get more than 100,000, right? So what's going to happen? That expense you that prepaid expense, that aggregate for so all of those remaining prepaid expenditure, because the aggregate is more than 100,000, what you're gonna do is you're not gonna recognize it that year. So do you see that even though that it met the scope, the implication still like was do not recognize this year. So when is very important. So firstly, you have to know what standard applies, and what standard applies is basically knowing that item. So do you see for income tax, just knowing that it's a prepaid expenditure in section 23H, it helps because that's the scope. And then implication is when you should recognize it first, and then measurement is um at what amount. So at what amount, you'll see these are things like at a lower of that and that divided. Do you see that's the calculation part of it. And then the when is the recognition part. So when should it apply in your tax calculations? So this approach is very important to use like in when you're reading scenarios and when you're answering. So I'm just going to go back to the exam and cover all the points, all the questions that we had. So the first one is that number 3, the rental income part. Ne? So I did explain the commercial buildings well. That one we didn't have a problem with it. Even the rent income, yeah, I said for tax and accounting purposes, it's treated the same. So we didn't really encounter a problem there. The only thing that I wanted to clarify here is the contract stipulated amount. So that lease improvement. So for the lease improvement, this is the rules. These are the rules. Firstly, if you have a contract stipulated amount, you use that amount. So the first thing for so let me explain lease improvement. So for lease improvement, the first thing you have to check is whether you are the lessor or the lessee, right? Because if you are the lessor, then you are going to have to include that leasehold improvement as an inclusion, right? Because the lessee gave you that so he effected those improvements, so it's an inclusion for you. However, those improvements are not entitled to them yet, since the lessee still residing in that property, right? So you have to also recognize or recognize relief for the lesser, right? So there are two things when you're a lesser. If they are if the lessee effects improvements, the first thing you have to record the leasehold improvement, right? The improvement amount straight, and then the relief for the lesser, right? The relief that SARS gives the lesser, right? So how exactly do you do this? So firstly, for the leasehold improvement, now I'm looking at the leasehold improvement calculation. So for that leasehold improvement, what happens is, this is what SARS says. The first thing you use, so the precedence is, the first thing you use is the contract stipulated amount. If there's a contract stipulated amount, it doesn't matter what amount, other amount they give you in the question, it doesn't really matter. You use that contract stipulated amount. And then if they didn't give you the contract stipulated amount, you're going to use the fair value of the fair value of that specific uh improvement. Yeah, so the real value, the reasonable value. So in this question, if let's say they didn't give us this contract stipulated amount of 70,000, yeah, they didn't give us this the contract stipulated amount. They said maybe this 70,000, um so maybe they said maybe this 70,000 was an amount that the lessee was expected to, yeah, maybe they say the 70,000 was the amount that um the lessee, yeah, was expected to incur, right? But you see that they just said this is the amount maybe that the lessee is expected to incur, but they didn't say anything about a contract, that it was an agreement between the lessor. So they didn't say anything about the contract. Do you see that in this case, that 70,000 won't be a contract stipulated amount? If it's not a contract stipulated amount, what you would have used in that case for the leasehold improvement would have been the 55,000, because the 55,000 is the reasonable value, is the closest to the correct value. So what SARS says, if you don't have a contract stipulated amount, use the correct value, the reasonable value of that specific improvement. So no lower of market value, or yeah, those rules. There's no law of, yeah, you just use the reasonable amount. That's for the leasehold improvement. And then for its so the relief for lesser, the relief for lesser is calculated like this is the formula for relief for lesser. So it's leasehold improvement. So that amount, whatever you got for the leasehold improvement, that amount minus the present value of that leasehold improvement discounted at 6%. You'll see in the question they already gave us the present value discounted at 6%. It was at 30,712. So what you're gonna do is, for the leasehold improvement, you're going to say 70,000 minus the 30,712. That gives us the relief for the lease. And don't forget, in this question, the leasehold improvement was 70,000, since they gave us the contract stipulated amount. I hope I clarify that one out. Okay. And let's go to 7 point. I think we can move on. Before we move on to number 7, I just want to also discuss the improvements part. So with regards to number 6, there was a question in our session with regards to improvements made to buildings. So with regards to improvements made to buildings, if it's a manufacturing building, that improvement will be treated as a normal cost. So you'll just add it. So we were correct here in number 6 by just adding this 1 million and just multiplying it by 5%. So improvements for manufacturing buildings, as long as like they are wholly, so wholly or mainly for the manufacturing process, like for trade, then yeah, you just include the whole amount. That 55% rule and 30% rule, I'll explain it now, because yeah, that was the question in the last session. So this is the explanation for it. So that rule is only applicable to commercial buildings, ne? And it's only applicable to commercial buildings where you buy part of the building. So if you buy part of a commercial building, ne, you're going to say 5% times that amount that you used to buy that part of the commercial building times 55%. That's where the 55% comes into play. So when you buy part of a commercial building, so commercial, and then that 30% rule is for improvements to that part of the building. So if you effect improvements to that part of the building, you're going to say 30% of those improvements times 5% as the allowance. So I hope I covered that one well. So that's the improvements part. And then we'll move on to 7.3. So for 7.3, just to clarify, the personal loan to the employee and the interest to the employee, those ones you won't deduct because that's a suspect trade. So yeah, those ones you won't deduct. Yeah, those ones you won't deduct, those ones. Okay, 7.4 and 7.5, those were okay. I think we covered those ones pretty well. Okay, 7.7. Okay, 7.7. They yeah, there's a mistake that I made there. So I went through the standard again, and there's a mistake that I made. You remember when we calculate for trading stock, what happens, right? So immediately when you purchase trading stock, you are going to record trading stock as a deduction, right? And then at the end of the year, what happens? Whatever closing stock you have, you are going to add it back, right? Also add back that stock. Don't forget the section 23F, that stock that so that the stock that's in transit, so the stock that the supplier has. So if the supplier has stock, it won't be included in your closing stock, right? Don't forget to also add that amount if you purchase stock from a supplier and that stock is not yet delivered. It won't be in your closing stock, so do not forget to add it back, that amount. And then that's what happens with trading stock, right? So we know that at the end of the year, that trading stock amount of 30,000 was already deducted. Do you see? It was already deducted, that amount, right? That amount of 30,000 for the trading stock was already deducted. Do you see? When the trading stock was firstly, so when the trading stock was purchased, it was deducted during this year of assessment, right? Even if the stock was opening stock, because what happens with trading stock? So trading stock rule is section 22, and what happens is at the beginning of the year, you're going to firstly deduct your opening stock, right? And then deduct all your purchases of trading stock this year. And then at the end of the year, you're gonna add back your closing stock and that section 23F. So that's stock in transit. That's the rule for trading stock, right? So do you see that this 30,000 was already removed when you purchase the stock, right? So you don't need to remove it again. So we made a mistake there by actually deducting that 30,000. You must not do anything with the 30,000. All you have to do is just include that 22,000 from the insurance company. Yeah, yeah, because it accrued to yeah, it accrued to the business. I assume it accrued to the business because they said the money was not yet received, right? So they didn't say anything about accrual. So the assumption is it accrued to the company. Yeah. And then just wanted to also clarify about that director embezzle 180,000. Don't forget that for tax purposes, that 180,000 is not deducted since that's a corrupt activity. Yeah. And then 7.8, with regards to the permanent billboard erected next to the M1 South. A permanent billboard is a capital asset, so you won't deduct it normally. So that's a capital asset, right? And then it's not part of the wear and tear group, so you won't deduct Section 11E allowances. It's not manufacturing, so you won't deduct Section 12C. This is not a building, so there's no building allowances. So for this permanent billboard, there is no allowances. Yeah. So that's what I wanted to clarify about. So the exam, these are the questions that we had. So I hope I clarified them out. Okay, I think we can move on now to vet from here. Yeah, let's move on. I think we can move on to vet. Can you please go to your AO2? So I'm going to go through your AO2, the exam. So the test you wrote in May. Please, yeah, I'm referring to that as an example for this question. So I think I can start. Okay, it says Milky Treats, like I said, that's the person we are. That's the company we are, right? It's a South African resident company. Milky Treats is a registered value-added tax vendor that makes 100% taxable supplies. And as a financial year end that ends on the last day of February, right? So they gave us the year of assessment here, it ends on the last day of February, right? And then they said Milky Treats manufacturers. Okay, before we read the scenario, let's read the required. It says prepare general entries to record the information for Milky Treats. So Milky Treats is the person, right? You know that that's a normal company. And then for the tax period ended January 2022. So they said tax period ended January 2022. So at this point in time, okay, they said tax period ended. So we know the date, right? So it's period ended January 2022, right? And then they said clearly give reasons for any verified in your answer through the narration. So do you see, because they said prepare normal journal entries, right? These are just they want accounting transactions, right? And if it's a normal accounting transaction with real accounting rules, with I mean, if it's a normal accounting transaction, normal accounting, yeah, like accounting journal entries, yeah, if it's normal accounting journal entries, right? What's going to happen here? The only thing that's going to remain constant for tax purposes is the VAT, right? Because yeah, accounting will still account for VAT using the correct VAT rules. However, accounting accounts for tax way differently from income tax. So what tax are they actually asking us in this question? They're asking us VAT. Do you see? This is why I said it's very important to know what they're asking you here. So here we know that they're asking us VAT since they asked us accounting general entries, and we know that accounting general entries, the only tax rule that remains the same when you're doing accounting is VAT. Otherwise, they would have asked you something like taxable income, because that's way different from like accounting. The tax rules, they are different from accounting. However, because we are doing journal entries, the VAT rules will be the same. So you know that here they are asking you VAT. That's the question here. So firstly, we know the person, we are the company, Milky Treats, right? The date or the date, the year of assessment, we know it ends on January 2022. And we know that for VAT purposes, we have to know what category that VAT vendor is, right? To know the period. We know the end is January 2022, but we don't really know the the VAT period, like the category. All we know that it's definitely not category B, because yeah, all we know is it's definitely not category B, because category B it ends on February, like the financial year ends on February. So we know definitely it's not category B, right? But we still have to determine, they still have to tell us what category it is to know that year of assessment. So for perspective wise, we're still not done. So we know the person, at least we know the tax that we are calculating, which is VAT. However, the date of assessment is still not clear about it yet. All we know is that January, is that it ends on January 2022. But what category, we're still yet to find out. So let's start reading the scenario. So it says milky treat. So that's the person that you are working with. That's basically the China entries. That's the company that you are working with, right? It's a South African resident company. Milky Treats is a registered value-added tax vendor that makes 100% taxable supplies and has a financial year that ends on the last day of February. So this financial year end, this is the normal financial year end, right? This is not the VAT one. So this is their normal financial year. If you're doing like taxable income, this date would have been important, but because we are doing tax VAT, I mean, it's not important because we will not reach February. Do you see? Then Milky Treats manufactures chocolates for the local and international market. So that's also a very important thing to note, um, because like you see that this international so the because Milky Treats manufactures also for the international market, right? You know that there are gonna be exports. Okay. Jane, Ellen and Jane, right? Both South African residents the company started the company in 2002. They are equal shareholders. Ellen is the managing director and Jane is the financial director. The company's offices and factory are situated in Kempton Park, Gauteng. Milky Treats is a category A vet vendor. So do you see now they told us the category. So we know that basically the vet period here is going to be from December, so 1 December 2002 to 31 January 2002. So that those 2 months, it's the vet period. So now we know the year of assessment, right? So we know the vet period. That's very important. Now we are done with perspective. As we're reading through the question, now we have to identify our triggers, right? So you are assisting Jane with the income tax and VAT treatment of certain transactions for the VAT period ended January 2022. The information, the following information relates to this period, right? So they're telling us that this information relates to this period. Then all amounts include VAT where applicable unless stated otherwise. Okay, let's continue. It says sales, local credit sales of 575,000 were invoiced. So what's the event that happened? So we know firstly local credit sales happens, right? So local credit sales. So sorry, what's the scope of local credit sales? So what's the scope of for local? So for VAT, how you decide the scope? Firstly, you have to decide what type of supply it is. That's the scope. So what type of supply is this local credit sale? Do you see that? We have to determine whether it is firstly so we have to determine firstly whether this supply is standard rate, zero rate, or it's an exempt supply, right? So here we can see that it's local sales, right? And local sales are just normal sales. Yeah. And because local sales are normal sales, it's going to be, so it's a standard supply, right? It's a standard rated supply. And what's the implication? So when should we recognize this thing? Don't forget, for VAT we use also the accrual basis, so we account for it when it accrued to us. So we know that these sales accrue to us during this VAT period, so we have to record it. We have to account for VAT in this period because using the accrual basis of accounting, and the sale did accrue to Milky Treats, right? So we know that that credit sale is a standard supply, and we know that it was within this VAT period, right? And for measurement purposes, yeah, that one is simple. You're just gonna say that 575,000 multiplied by if you it depends what you want. So firstly, okay, before we calculate that amount, I get we are doing general entries, right? So with these general entries, we know that there's VAT, right? So what's going to happen? We know that this is a normal sale. So for accounting purposes, Firstly, we know that when you sell something, you have to create revenue, right? So we're gonna create revenue, and then we are going to have to debit the receivables since this is a credit sales, right? Debit receivables. However, we also know that this credit sale there's VAT, right? We've determined that there's VAT, so we also have to calculate the VAT output here. Why? Why is it VAT output? Because we are supposed to receive the money, right? Yeah. So those people, so the people who bought the customers who bought that, so the customers who bought whatever they bought from Milky Treats, they are the ones that paid VAT. So we just facilitating that VAT payment. So that's why it's output tax, right? Because they are the one that's paid. So they are the one that paid, right? So what are the general entries going to be? Firstly, we are going to say receivables we debit with that full amount, right? Because it doesn't matter, the customer has to pay that full amount, so he owes that amount. So receivable we debit to that amount, and then you're going to credit output tax with 75,000 and revenue with 500,000. That's after saying 575,000. So for, let's say you're calculating the 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 VAT. So you're going to say 575,000 multiplied by 15 over 115. So yeah, then you get your VAT. So your VAT is 75,000. So, and which means your sales, your revenue amount is 500,000. And then that's how you do the first one. We can continue to the next one. So the next point says a cash sale of 1.5 million was made to a company in Nigeria, right? So the first thing we do before we even think of the accounting general entry for it, we want to determine whether VAT is applicable here, right? So they say the cash sale of 1.5 million was made, right? So a sale, you know that the customer is the one that's paying VAT, so it's VAT output, right? Yeah. Then they tell us that a cash sale was made to a company in Nigeria. So do you see that this company, these are not local sales, these are foreign sales, right? Number one. So the event is a foreign sale, right? And what is a foreign sale? Is within what scope? The scope of zero rated supplies, right? Because it's an export. You are exporting goods, right? Because you're exporting goods, what do they say? Zero rate. So VAT is going to be charged at what? 0%. So for accounting purposes, there's no VAT. But for VAT purposes, the VAT is charged at 0%. So which means it's zero, right? Then what does it mean? It means that basically no VAT, right? For that. So no VAT amount, because the VAT is zero rated. It's calculated at 0%, not 15%. So what's the general entry going to be here? It's going to just be bank, because it's a cash sale, right? Going to be bank, we debit, and then you're going to credit the sales or the revenue. Yeah, sales or the revenue. Yeah. And then we move on to number three. Number three says a deposit of 500,000 was received from a company in Cape Town for goods to be invoiced and delivered in February 2021, right? So I think that 20 good to be invoiced, okay, delivered in 2021. Okay, I think that 2021 supposed to be 2022. Yeah, I think they made a mistake here. So I'll assume it's 2022 because yeah, 2021 was last year. Yeah, so I'm just gonna assume they meant 2022 here. So they say the deposit of 500,000 was received from a company in Cape Town. So in Cape Town, this is a local company, right? So this is a normal sale. For goods to be invoiced and delivered in February, right, 2022. It is the policy of Milky Treats, right, that deposits are to be forfeited, lost, if the final order is not placed with the company within um, 30 days, right? So where are we now? We are on the 31st of, so 31st of what? we are on the 31st of January, right? 31st of January 2022, right? And these goods have to be delivered when February, right? When does February end? Do you see that the latest is 29th, right? And if we are on the 31st of January and the highest is the 29th or the 28th, do you see that that's less than 30 days, right? Because they said the final order must be placed within 30 days. So do you see that that's less than 30 days? So for accounting purposes, we are entitled to that amount, right? Because, and like, not even for accounting people, we are entitled to the amount according to the contract, right? Because they say there's company policy that deposits are forfeited, right? If the order is not placed with the company within 30 days, right? So what's going to happen? Do you see that that 500,000 they already forfeited, right? And forfeited means that it means that it's a normal sale now. Because they forfeited that amount, we're gonna treat it as a normal sale that we sold to them 500,000. So we're entitled to that revenue amount, right? So what's going to happen? The first thing is, what's the scope? That thing is a normal standard supply, right? Why? Because it's a deposit for goods. So it's a deposit for goods, or I don't know what this company treats, but I think it's goods, yeah. So yeah, chocolates, yeah. So this 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 500,000 was a deposit, right, for those chocolates, right? Now, do you see that the company is unconditionally entitled to that 500,000 now, because they didn't place this order, that company that's based in Cape Town, because they're unconditionally entitled to that amount. For what? For those goods, right? Do you see that they're unconditionally entitled to that, to they're unconditionally entitled to that 500,000 because of the revenue transaction, right? Right, so that's a standard supply, because it's also a local sale. So what's going to happen is this is going to be treated like a normal sale, a normal local sale. So I'm just gonna say that 500,000, you already charged VAT in that 500,000. So what you're going to do is you are going to say bank you debit, right, with that 500,000, because that's what you received. However, in that 500,000, don't forget that there's also VAT, right, in that 500,000. So don't forget to multiply VAT by saying 15 over, so 500,000 multiplied by 15 over 115, that gives you your output tax, because the customer is the one that paid. So yeah, you are just the one that facilitates the VAT payment. So it's output tax. We can move on. It says number 4, a new double cab bike, right? A motor car is defined, right, of 609 500. So a new bike of 600, so 609,500 for cash. The bike would be used as a delivery vehicle. So do you see that? Even so now, for VAT purposes, it doesn't really matter what the company intends. So the intention of the company, it does, okay, the intention of the company does matter in terms of like the use of certain assets. So these assets have to produce taxable supplies, right? However, when I say the intention doesn't matter, I mean the intention of um I'm talking about those three goods or services that fall into VAT input denied, right? You know those ones. So food and beverages, motor cars, and the fees and membership. So that one, it doesn't really matter what the company does with that specific expense. If it's defined as a motor car, like in this case, then yeah, if it's defined like as a motor car, then this the same rule will apply. VAT input denied will apply. So don't forget now, with the VAT input denied, the supplier who's selling this double cab bike, that 609,500 does have VAT inside, right? It's just that you are not entitled to that VAT according to SARS, right? It says you're not entitled to that to that input VAT. Because don't forget, when you buy something, um you also pay VAT, right? And that VAT you pay, SARS has to pay it basically back to you. But for these ones, SARS says even though there's VAT, the supplier charged VAT for these ones, we won't pay you back these ones because these items are entertainment as defined, right? So with this one, although there is VAT in the 609,500, you will not account for VAT here, right? So in terms of accounting, all you're gonna do is say firstly bank you credit because it's an amount, and then the motor vehicle you you bank you credit, right? And then the motor vehicle you debit. So bank you credit because you used cash, and then motor vehicle you credit, or PPE you credit, yeah. And then we move on to number 5. So number 5, it says petrol expenses relating to a delivery vehicle amounts to 39,920, right? 39,920. So the first thing is what like, okay, for number 4, and I just wanted to use this approach for number 4 and show you again that it works. So the scope for here, you know that a motor vehicle, it's a normal standard supply, right? However, implication, the reason why we didn't do anything there is because this a VAT input denied item. That's why we didn't do anything with it. And then they said petrol expenses relating to delivery vehicles amounts to 31,920, right? So what are these petrol expenses? What type of supply these petrol expenses? Petrol expenses are zero rated supplies. So because they are zero rated supplies, the VAT is charged at 0%. Therefore, for accounting purposes, there is no VAT, and for VAT purposes, it's zero, right? So what you're gonna do is the just going to say bank you credit with that amount, and then petrol expenses you debit. No VAT, no VAT because it's zero rated. And then a new fridge was purchased from Wired Ltd for 16,100. The admin staff will use the fridge to store their lunches and beverages. So do you see that specific capital asset um, basically is used for entertainment purposes because it's used to keep the lunch and beverages, right? So that specific asset will be used for entertainment purposes. So even though it's a standard supply, so the scope of it is standard supply, that standard supply is basically input denied, right? So what the fridge is just gonna say normal bank credit, and then the so that fridge, so you can say PP again because it's part of your property, um 16,100, or you could just say fridge or furniture and equipment. So it doesn't really matter what term you used, as long as you understand what you're right. Because for general entries are just used by accountants, right? to to so they're just used by accountants, right? To just reveal some information. However, they don't really matter in terms of like the way they are written, since there's a standard IS1 presentation of financial statements that gives you like um requirements as to how statements have to be prepared. So with regards to journal entries, they are just a tool that the accountant uses really to compile the statements. So that's why these so what you really write on those journal entries, they don't really matter. That's why even for journal entries, they want journal narrations, you see, because journal narrations actually explain that term that you wrote, right? So um I'm just saying this because I don't want you to get fixated like on the terms, especially the accounting terms. However, for tax, like tax is fixated like on terms. Ne? So use the correct term. And okay, number 7, it says SICA membership fees paid for Jane amounted to 4,600. So um these are, so the first thing is we're going to look at the scope, right? This is a normal standard supply, right? Because they charged VAT on this. However, you know that fees and so members, so fees and subscriptions, you know that they're entertainment, unless obviously they are to a professional body. So in this case, they are to a professional body, so they are not entertainment. So you can claim input input so you can claim input tax on it, so input VAT. So what happens is they paid, right? So bank you credit with that full amount, and then you're gonna debit the input tax and basically the employee expenses, because those membership fees were paid for the employees, right? And then he said local airfares of 2,300 were incurred for Jane to attend a corporate governance seminar in Cape Town, right? So this is air travel, right? And air travel within the republic, right? So air travel within the republic is standard rate supply. If at least it was outside the republic, then it was going to be a zero rate supply. And if it was um so normal rate or roll within the country, then it was going to be zero rate. Not zero rate, I mean an exempt supply, that one. So this one is a standard supply because it's local air travel. So because it's an exempt supply, and it's not input denied, so we can claim our input tax here. So the first thing is they paid for it. So bank, you're going to credit with that full amount, and then you're gonna debit the input tax with that amount. And this is we're gonna also debit the local air travel. So that's just the expense you're gonna debit. And then number 9, it says Milky Treats paid 8,000 interest on their overdraft. What type of supply it is it is an exempt supply because it is a financial service. Don't forget things like interest. Interest is a financial service. However, bank charges are not a financial service, right? Bank charges, are a bank service. They are not a financial service. They are just a bank service charge, right? They are just charging you for using the bank's facilities. They are not charging you for that specific loan. So you'll see the so do you see that 8,000? You have to know basically what a financial service is. Right? So a financial service is things that are within, let's say you get something like a loan, right? You get something like a loan, like for instance, do you see that you're going to pay something like interest, right? That interest that you pay, that's a financial service. However, the charges that are relating to opening that account or for withdrawing, or those charges that you just earn, those bank charges, not earn, I mean that you have to pay every month, right? Those bank charges are not financial services. Those are just normal bank services. So that's the service for the bank, right? Right, that's the service for the bank, right? And those ones, because the service for the bank, those ones will be normal standard rate, right? Because a bank is still a business, right? So with regards to their bank services, so if it's bank charges, it's a normal standard rate and there's tax in it, right? However, for financial services are exempt supplies, so there is no VAT there. And basically the general entry is going to be bank, you debit with that I mean credit, because it's interest paid right on overdraft. So bank you credit with 8,000, and the interest on overdraft you debit with the 8,000. And yeah, that's basically how you do the VAT for that was the VAT for AO2, right? I did go through the VAT in the exam, and honestly, it's similar to the one in AO2. However, I'll just go through some of the things that I think are important for VAT purposes. So let's go to the question 2 in your exam paper. I'm not gonna really go through everything. Like I said, I'm just gonna go through a few transactions that I feel like AO2 didn't cover. So for transaction 1, as you can see, they say firstly, John pays the monthly salaries. For those salaries, I just wanted to remind you that salaries do not even form part of VAT, because VAT says that specific transaction must be run um, for for the enterprise, right. This thing does not meet the definition of an enterprise, the employee services. So employee services don't meet the definition of an enterprise, right? So they do not meet the definition of an enterprise. So yeah, this so basically what they're saying is these salaries are not a cost used to further the 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 enterprise. So they are not part of the definition of an enterprise. So when you meet any payment from an employer to an employee, there's no VAT on that payment, right? Because it doesn't meet the definition of that enterprise. So it's not even within the supply. So it's not a standard, it's not even a supply, right? Yeah, that's why there's no VAT there for it. And then okay, transaction 2 speaks about the interest. I did speak about financial services right now. Okay, I did speak about membership fee that they are denied. Um, yeah, and for transaction 4, don't forget that the sale of milk, milk is a 0 rated. Okay, if we can move on, transaction 5, okay, this is residential accommodation, and that's exempt. um okay, yeah, for the insurance, yeah, I just wanted to cover the insurance or the indemnity part. So also insurance can also be called like indemnity. So insurance so with any insurance amount that amount that the insurance company gives you there's a deemed VAT. So the insurance company does not really charge VAT. However, there's a deemed VAT. So SARS says, although the insurance company didn't charge you VAT, we are going to take it as if they charged you VAT. So that amount that you have, that amount, it has VAT inside. So that amount that the insurance company, doesn't matter what it gives you, that payout, it has VAT inside, although they didn't calculate VAT, right, and add it. Don't forget that. Yeah. And then okay, for transaction 7, we've got accommodation at a hotel, so that's a normal commercial accommodation. And yeah, that's just for a few nights, right? And the meals at that same hotel, so those meals, they are so basically that meal was eaten in the furtherance of an enterprise, right? Well, it's a subsistence allowance, right? That meal. So that means that yeah, there's going to be normal VAT for that meal. However, for that meal, I have to again check on the standard and just confirm with that meal. But yeah, for that meal, I think it's going to be charged normal VAT for that meal since it's in the furtherance of an enterprise. However, I will check it and text you, yeah, text you in the group, yeah, before you guys write. So yeah, that's VAT and the income tax question. So I hope I covered everything well, and good luck to your good luck with your supplementary exams.